Hello everyone, welcome back to my channel. In this video, we're going to be talking about insurance and how it is a risk management tool. But to start, let us first define what is risk. Risk can be defined as the possibility of a loss or injury. This could be financial loss, physical injury, the loss of a life, and the loss or injury can be minor as well. It doesn't have to be catastrophic. And what is risk management? Risk management is the act of adjusting the risk to a reasonable amount. For example, minimizing the possibility of occurrence or minimizing the impact of the loss or injury. Or sometimes you can even increase the risk if the reward is worth it. It is worth noting that it is impossible to completely eliminate risk, because if we were to completely eliminate risk, we would not be able to function as normal human beings. For example, even if you go out and buy food for yourself, you are still exposed to the risk of falling down or getting hit by a bus. Or the alternative is that you starve lor. So now that we know what are risks and what is risk management, let's talk about some of the tools that you can use to help you manage risk. And to help you understand this a little bit better, we're gonna use this matrix over here. This is called a risk matrix, and the risk can be low probability and has low consequence, or it can be low possibility and high consequence, or high possibility and low consequence, or high possibility and high consequence. A low possibility and low consequence activity might be you going out to buy food. The possibility of loss or injury is quite low, and also even if it happens, the consequences is also quite low. It is unlikely that you will sustain heavy injury from just going out to buy food. The next example is a high possibility and low impact risk. For example, contact sports like playing basketball. The probability of you getting injured is quite high. However, the consequences of it is unlikely to be catastrophic. At most, you fall down or get hit in the face by a ball, and that's unlikely to be life-threatening. Next, we're going to be talking about high possibility and high consequences risk. An example of this is like drink driving. The possibility of getting into an accident is high, and if you do, the consequences can be quite dire. And lastly is a low possibility and high consequence risk. An example of that is fire occurrence in your house. Although the chance of your house catching fire is quite low, but the consequence of it can be quite bad. So now that we've talked about the risk matrix and its quadrants, what are some of the risk management tools that you can adopt to mitigate some of the risk? For low possibility and low consequence risk, you probably will want to just retain the risk. That means just accept the risk. And going back to my previous example, if you need to go out and buy your food, just go and buy your food. Next is the high possibility and low consequence risk. So you can mitigate this risk by reducing it. For example, if you want to play contact sports like basketball, you can reduce the risk by wearing protective gear or reduce the amount of play time. That way it will reduce the possibility of you getting injured. Next is the high possibility and high consequence risk. The risk management tool for that is to completely avoid those activities. For example, drink driving, don't do it at all. Completely avoid it. And lastly is the low possibility and high consequence risk. And the risk management tool for that is to transfer away the risk. And that is where insurance come into play. Insurance is a risk management tool because it allows you to transfer financial risk from yourself to the insurance company. For example, if a fire were to break out in your house, and if you have fire insurance, the insurance company will pay for the damages that the fire has caused, and you don't have to pay for the repair and the replacement of your fixture and fitting. So essentially what you have done is to transfer the financial risk from yourself to the insurance company, because they will be the one paying instead of you. And it is worth noting that even though you cannot use insurance to transfer the risk of a physical loss or a loss of life, you can, however, use it to reduce the financial impact that you potentially might face in the future. Another example is medical expenses. For example, if you were to be hospitalized, you will definitely require medical attention, and those medical attention probably would require medical expenses, which you will have to pay. So again, having insurance can help you transfer your financial risk from yourself to the insurance company. Alright, we are almost at the end of the video. Let's just do a quick recap. Firstly, what is risk? Risk is the possibility of a loss or an injury, and risk management is the act of adjusting the risk to a reasonable level. Secondly, the risk matrix shows us the relationships between consequences and possibility of risk. And third, the 4 risk management tools are retain, reduce, avoid, and transfer. And lastly, how is insurance a risk management tool? Insurance can allow you to transfer financial risk from yourself to the insurance company. Thank you very much for watching till the end. I hope you've learned something new today. Give me a thumbs up if you like the video, and subscribe if you like the content. And if you have any questions, do write them in the comment section below so that I can answer them. Thank you very much for watching. I'll see you guys in the next video. Bye bye.